Let me ask you something before we even get started. Have you ever watched a chess grandmaster voluntarily sacrifice a powerful piece early in the game? To the untrained eye, it looks like a mistake. It looks like weakness. It looks like they're losing. But the grandmaster isn't losing, they're setting up a move that won't pay off for another 10 steps. That's exactly the lens you need to understand what just happened in the XRP ETF market. Because on the surface, a major player just walked away, and the internet predictably lost its mind. But what if walking away was actually the smartest move on the board? What if the real story isn't about who left but about who's about to enter? And what if the supply mechanics quietly building underneath all of this are about to create one of the most significant price events XRP has ever seen? Stick with me, because today we are going deep. We're talking facts, speculation, legal constraints, institutional strategy, supply chain economics, and what all of it means for you as someone holding XRP right now. This is going to be one of the most important videos I've made in a long time. Let's go. What's going on, everyone? Welcome back. If this is your first time here, I want you to know exactly what this channel is about. We don't hype, we don't panic. We don't chase headlines without understanding what's actually underneath them. What we do is sit down, slow down, and separate the facts from the noise. And in a market that moves as fast as crypto does, that discipline is worth more than any price prediction. So if that's the kind of content you're looking for, you're in the right place. Hit that subscribe button and let's build together. Now let's get into it. It started like so many crypto stories do, on X, formerly Twitter. Someone asked an AI tool whether BlackRock and Fidelity were planning to file spot XRP ETFs. The AI responded with something that sounded very confident and very specific. It said, yes, these giants are rumored to be filing soon. That response got screenshotted. That screenshot got shared, and within hours it was everywhere. Thousands of accounts amplifying it, debating it, building entire narratives on top of it. And then, almost as if on cue, news dropped that CoinShares had officially withdrawn their spot XRP ETF filing with the SEC. People connected those two dots immediately. CoinShares is running scared because BlackRock is coming. The giants are moving in and the small players can't compete. It made for a great story. The problem is, a great story and an accurate story are not always the same thing. So today we are going to take this apart piece by piece. We are going to tell you exactly what is confirmed, what is speculation, and what the real implications are. No drama, just clarity. Let's start with the one thing we know for certain. CoinShares filed a Form RU with the United States Securities and Exchange Commission. RU stands for Request for Withdrawal. This is not a pause. This is not a delay. This is not a strategic repositioning inside the same filing framework. A Form RU means the entire registration is being pulled. Think of it like this: if filing an ETF application is like opening a store, then filing an RU is like calling the landlord, canceling the lease, packing up every single box, and driving away. The store is not temporarily closed. The store does not exist anymore. Now, it's worth noting that under SEC Rule 477, no shares were ever sold through this filing. No investor money changed hands. No XRP was purchased on behalf of any fund. The withdrawal happened before any of that could occur. So from a pure investor protection standpoint, nobody got hurt here, but the signal it sends to the market is significant, and we need to understand what that signal actually means, not what people are projecting onto it. Before we interpret the withdrawal, you need to understand who CoinShares actually is. Because if you don't know the size of the player who just left the table, you can't properly evaluate the move. CoinShares is one of the oldest and most respected digital asset managers in Europe. They have been in this industry since the early days, long before most of the current wave of institutional players showed up. Across their product lineup, they manage somewhere between $7 and $10 billion in digital assets under management. That number varies depending on when it was measured and how crypto valuations were moving at the time. But the key point is, this is not a small operation. Their flagship product, the CoinShares Physical Bitcoin NetP, has grown to become the largest physically backed Bitcoin NetP in all of Europe by assets under management. We're talking roughly $8.9 billion in a single product. That's an extraordinary achievement in a competitive market. They also run a physical XRP ETF in Europe launched back in April 2021, which currently sits at around $245 million in assets under management. So CoinShares has real experience with XRP products. They understand the asset, they understand the demand, and they clearly believed at some point that a US spot XRP ETF was worth pursuing. So what changed? Here's my take, and I want to be clear, this is analysis, not confirmed fact. The US ETF market for digital assets is undergoing a consolidation phase. And in consolidation phases, the middle gets squeezed out. Think about what happened to retail when Amazon arrived. It wasn't just the tiny shops that struggled. Even medium-sized regional chains, companies with decades of history and loyal customer bases, found themselves unable to compete on price, on logistics, on scale. The same dynamic is playing out in the digital asset ETF space right now. When you have firms like BlackRock, Fidelity, and Franklin Templeton entering a product category, firms with multi-trillion-dollar distribution networks, household name recognition, and the ability to operate at near-zero margins for years while building market share, the calculus for everyone else changes dramatically. CoinShares is not a small company. But in the context of the US market, competing against those giants for XRP ETF market share would require enormous capital, enormous patience, and enormous risk. And here's the thing: they don't need to compete there. In Europe, they are already dominant. Their XRP ETF faces far less competition. Their margins are healthier. Their brand is established. Why spend resources fighting a war in someone else's territory when you're already winning at home? There's also another factor worth mentioning. CoinShares has been focused on a significant strategic milestone: their listing on NASDAQ. That kind of corporate event requires management bandwidth, legal resources, and institutional credibility. Withdrawing from a competitive US ETF race actually makes the company look more focused and disciplined to potential investors evaluating them foreign as delisting. This wasn't a retreat born from weakness. This was a calculated resource allocation decision. And frankly, it's the kind of move that sophisticated operators make. Now I want to spend a moment on something that I think is really important for anyone navigating crypto markets in 2024 and beyond. The speed at which narratives form and spread in this space has become genuinely dangerous. Not dangerous in a dramatic sense, but dangerous in the sense that bad information acted upon quickly costs people real money. The CoinShares withdrawal story is a perfect case study. Within hours of the filing hitting the SEC database, there were posts declaring that XRP was done, that the ETF dream was dead, that institutions were losing faith. At the same time, on the exact opposite end, there were posts declaring that BlackRock and Fidelity were definitely filing, that CoinShares knew something we didn't, and that XRP was about to explode. Both sets of posts were wrong. Both sets of posts were based on speculation dressed up as analysis, and both sets of posts were spreading faster than anyone could fact-check them. Here's the discipline I want you to carry with you. When a major news event breaks in crypto, give yourself 24 to 48 hours before forming a strong opinion. Let the dust settle. Let the actual documents surface. Let people who understand regulatory filings weigh in. The people who move fastest in crypto markets are often the people who lose the most. The people who pause, think, and verify, those are the people who consistently make better decisions. Alright, let's talk about the elephant in the room. Are BlackRock and Fidelity actually planning to file spot XRP ETFs? Here is the honest answer: we do not know. As of this recording, there is no firm S1, no registration statement, no official filing of any kind from either BlackRock or Fidelity related to XRP on the SEC's Edgar database. What exists is a rumor. That rumor was amplified by an AI tool responding to a speculative question, and I want to take a moment here to talk about why that matters, because I think a lot of people misunderstand how AI tools work in this context. When you ask an AI a question, it doesn't go to a live database and pull confirmed facts. It generates a response based on patterns in the data it was trained on, which includes everything from SEC filings to random tweets to speculative blog posts. If thousands of people have been speculating on social media that BlackRock might file an XRP ETF, that speculation gets absorbed into the AI's training data. And when you ask the AI about it, it may surface that speculation in a way that sounds authoritative and factual. But speculation repeated confidently is still speculation. It doesn't become a fact just because an AI says it with confidence. So let's be very clear. The BlackRock and Fidelity XRP ETF filing is, as of right now, an unconfirmed rumor. Treat it as such until you see a document. Now, with that caveat firmly established, let's talk about whether it's plausible, because plausibility matters too, and honestly, the conditions for a BlackRock or Fidelity XRP ETF filing have never been better. Let me walk you through why. First, regulatory clarity. XRP spent years under the shadow of the SEC lawsuit against Ripple. That lawsuit created enormous legal uncertainty. Institutional investors don't like legal uncertainty. Compliance teams don't like legal uncertainty. The kind of firms that manage pension funds and retirement accounts cannot afford to touch an asset that might be ruled a security and create regulatory liability for them. That uncertainty has materially decreased. The legal landscape around XRP is clearer today than it has been in years. And when legal clarity increases, institutional appetite follows. Second, precedent. BlackRock has already filed and received approval for a spot Bitcoin ETF. They have done this before. They understand the process, they have the regulatory relationships, and they have the infrastructure. Filing a spot XRP ETF would be an extension of existing work, not starting from scratch. Third, competitive pressure. Franklin Templeton, Canary Capital, Bitwise, and others are already in the XRP ETF race. Daily inflow numbers for existing XRP products are growing. The demand signal is clear. For a firm like BlackRock or Fidelity, allowing competitors to establish dominant positions in a high-demand product category is a strategic risk they take seriously. First mover advantage in ETF products is real. It drives fee income, growth, and brand positioning for years. So when you add up regulatory clarity, proven infrastructure, and competitive pressure, yes, it is absolutely plausible that BlackRock or Fidelity are considering this move, but plausible and confirmed are two very different things. And until we see a document, we stay in the plausible column. Okay, now we get into the part of this story that I genuinely believe is the most important and the most underreported. And it's going to require us to go a little deeper than most crypto channels will. But I promise you, if you understand this, you will understand XRP's price mechanics at a level that puts you ahead of 90% of retail investors. Here's the core question. When institutional ETF providers need to buy large amounts of XRP to back their products, where do they actually get it? The intuitive answer is Ripple. Ripple holds enormous amounts of XRP in escrow. Ripple releases a portion of that escrow every month. Surely the simplest path is for ETF providers to just call up Ripple and make a deal, right? Wrong. And the reason why comes down to a 2023 court ruling that fundamentally changed the landscape. In that ruling, a federal judge determined that direct institutional sales of XRP by Ripple, meaning private deals where Ripple sold XRP directly to institutional investors, constituted unregistered securities offerings. This is a specific legal conclusion with specific legal consequences. It means that if Ripple tries to sell XRP directly to a hedge fund or a bank or an ETF provider, that transaction falls under securities law. And since Ripple never registered XRP as a security, those direct institutional sales are prohibited. Now, Ripple did receive some limited relief following the settlement of the broader SEC case. Specifically, the company was granted a waiver allowing it to raise capital from accredited investors under a specific regulatory exemption. But here's the critical nuance that a lot of people miss: that waiver is narrow. It does not reopen the door to the broad, large-scale direct institutional XRP sales that Ripple was doing before the lawsuit. It is not a blanket permission slip. It is a limited, structured exemption, and it does not change the fundamental legal constraint on direct primary market sales of XRP by Ripple to us institutions. Now, here's where it gets interesting, because there's a theory that's been circulating in the XRP community about a potential workaround. Ripple operates a prime brokerage platform called Ripple Prime. Ripple Prime is designed to offer institutional clients access to OTC spot execution, clearing, and collateral services for digital assets, including XRP. So the theory goes, what if Ripple uses Ripple Prime as the vehicle for institutional XRP sales? What if they route the transactions through this brokerage arm and call it a secondary market operation rather than a direct primary sale? It's a creative thought, and I understand why people are drawn to it, because finding loopholes and structural workarounds is part of how sophisticated financial markets operate. But the legal analysis here is pretty clear. Courts and the SEC look at the economic substance of a transaction, not just its structural form. If Ripple is still the ultimate source of the XRP flowing to institutional buyers, whether directly or through a brokerage intermediary, the legal analysis doesn't change. You can't put a different label on the same bottle and expect regulators to treat it as a fundamentally different product. The court's ruling and the injunction that followed targeted the substance of what was happening: Ripple selling XRP to institutions in a way that met the definition of an investment contract. Changing the sales channel doesn't change that substance. Now, there is one area where Ripple Prime can legitimately operate: if Ripple Prime is acting as a pure intermediary, matching institutional buyers with XRP from third-party sellers, exchanges, or OTC desks that are not Ripple itself. That's a different situation. That's a brokerage function, not a primary issuance. And that is probably legal under the current framework. But it means Ripple Prime cannot be used as a backdoor for offloading Ripple's own XRP holdings or escrow releases to us institutional buyers. The constraint remains. I don't want to leave you with the impression that Ripple is completely boxed in, because that's not accurate. Either, there are compliant paths available to them. The ruling and subsequent settlement specifically targeted unregistered institutional offerings that met the investment contract test. They did not prohibit Ripple from all XRP-related commercial activity. Ripple can still pursue registered offerings, meaning if they go through the proper SEC registration process, they could potentially conduct institutional XRP sales legally. Ripple can still operate outside the United States under different regulatory frameworks. Many countries have clearer, more permissive rules around digital asset sales. If Ripple sells XRP to an institution in Europe or Asia that operates under a different legal framework, that transaction may be entirely legal. Whether those institutions then bring that XRP into the US market is a separate question, and one that probably requires a very experienced securities lawyer to fully answer. Ripple can also continue to release escrow XRP into the open market through programmatic sales, algorithmic sales on public exchanges. The court specifically found that these programmatic sales were not unregistered securities offerings. The reasoning was that buyers in open market transactions don't know they're buying from Ripple. Specifically, and they're not investing in Ripple's success in the same way as direct institutional buyers. So the programmatic release channel remains open. But again, that goes to exchanges, not directly to ETF providers. So if ETF providers can't buy directly from Ripple, what are their actual sourcing options? Let's map this out clearly. Option 1. Tier 1 exchanges. Coinbase, Binance, Kraken, Uphold, Bitstamp. These platforms hold large amounts of XRP and serve as primary liquidity venues. An ETF provider can go to these exchanges and purchase XRP through normal market mechanisms. The advantage here is accessibility and regulatory clarity. These are established, compliant venues. The disadvantage is market impact. If you're trying to buy $50 million worth of XRP through a public exchange order book, you're going to move the price significantly. Option 2. OTC desks, over-the-counter desks allow large buyers and sellers to transact directly off the public order books. Think of it like a private negotiation versus a public auction. In a public auction, everyone sees your bid. In a private negotiation, the transaction happens quietly and the public market doesn't immediately feel the impact. OTC desks have historically been the preferred channel for large institutional XRP purchases precisely because they allow institutions to move significant capital without triggering immediate price volatility. Option 3. Dark pools and private block trades. Similar to OTC in concept, large transactions negotiated privately between institutional counterparties. These channels are less accessible but allow for the largest transaction sizes. Option 4. Large secondary market holders. This includes funds, treasuries, and eventually retail holders who are willing to transact in large blocks. As OTC inventory depletes, institutions may increasingly turn to this category, negotiating directly with large XRP holders to acquire the positions they need. Now here's where I need your full attention because this is the part of the story that I think has the most significant implications for XRP price. OTC desks are not an infinite supply. They hold inventory. That inventory gets replenished through their own market activity, through relationships with large holders, through arbitrage. But the rate at which institutional ETF demand is drawing down OTC inventory has been accelerating. Current estimates from market analysts suggest that somewhere between 1 and 2 billion XRP may still be sitting in OTC and dark pool inventories. That sounds like a lot, but consider the context. Multiple ETF products are now active or approaching launch. Franklin Templeton, Canary Capital, Bitwise all buying 21 shares. XRP ETF was expected to go live, adding even more demand to the equation. And if BlackRock or Fidelity enter this space, the scale of demand increases by an order of magnitude. These firms don't buy 10 million or 20 million, they buy hundreds of millions. They buy in sizes that can exhaust OTC inventory in ways that smaller players never could. So what happens when the OTC inventory runs out? Institutions have to go to the open market. They have to buy on public exchanges, through visible order books, in real time. And that changes everything. Let me give you a mental model that I think makes this crystal clear. Imagine a city built next to a large lake. The lake represents the public XRP market, the exchanges, the visible order books, the price you see when you look at a chart. For months, the city has been drawing its water not from the lake but from a system of underground aquifers. These aquifers are the OTC desks, deep, large, and invisible to anyone just looking at the surface of the lake. As long as the city draws from the aquifers, the lake stays full. The surface stays calm. Residents, retail investors looking at price charts see no movement. No alarm. But underground, the aquifers are being drawn down, slowly and steadily, every single day. Now imagine the aquifers run dry. The city still needs water, so it turns to the lake, and suddenly the waterline starts dropping visibly, measurably, undeniably. Everyone can see it. Everyone reacts to it. That is the price. Mechanics of OTC depletion. Right now, institutional demand is being absorbed by OTC inventory, the underground aquifer. The price chart looks relatively calm because that demand isn't hitting the visible market. But when the OTC inventory is gone, every dollar of institutional demand has to flow through public exchanges. A $50 million buy order hitting an order book with only $3 or $4 million in depth doesn't get filled at the current price. It gets filled at whatever price the market has to reach to satisfy that order. That's not a prediction, that's basic market mechanics. And it's why the combination of institutional demand, legal sourcing constraints, and OTC depletion creates a setup that serious XRP analysts have been tracking very carefully. Let me add one more layer to this supply picture. Current XRP balances sitting on exchanges are estimated at around 4.2 billion XRP. Now that sounds like plenty of supply. But here's the nuance. Not all of that XRP is actually available for purchase. Some of it belongs to exchanges themselves as operational reserves. Some of it belongs to long-term holders who have no intention of selling at current prices. Some of it is locked in various trading strategies, lending protocols, or institutional custody arrangements. The wallets on the XRP rich list show names you'd recognize: Coinbase, Binance, Kraken, but those balances represent a mix of exchange reserves and customer holdings that can't easily be disentangled. So when you see 4.2 billion XRP on exchanges, the actual liquid, available for purchase supply is meaningfully smaller than that headline number suggests. And that matters. Because if institutional demand starts hitting the visible market while the actually available supply is smaller than people assume, the price dynamics get amplified. This is not speculation. This is supply and demand logic applied to a market with unique structural constraints. Let's zoom out from the supply question and look at the broader ETF picture. Because the XRP ETF race is moving faster than most people realize. Franklin Templeton currently has significant XRP ETF assets under management. Canary Capital is right behind them. Bitwise is in the race. 21Shares was expected to launch their XRP ETF product, which would add yet another institutional entry point for XRP exposure. And the regulatory environment that makes all of this possible has been dramatically improving. The SEC under new leadership has been taking a noticeably different approach to digital asset products. Applications are moving through the review process faster. Communication between issuers and regulators has improved. The overall tone has shifted from adversarial to collaborative, and that shift matters enormously for the pace at which new XRP products can come to market. What we're watching right now is the early innings of a much larger institutional adoption wave. The products that are live today and the products about to launch are building the infrastructure and the precedent for the much larger players who may come after. Think of it like a highway being built. The first few cars on a new highway don't generate traffic jams. But once the highway is proven, once people trust it, once businesses build around it, traffic grows exponentially. XRP ETF highway is being built right now. And we are watching the first few cars get on. I want to address something directly because I know it's on a lot of people's minds. Is the CoinShares withdrawal, taken together with all of this other information, a bullish or bearish signal for XRP? My honest analysis, it's bullish. And here's why I say that with confidence. The withdrawal was not caused by declining interest in XRP as an asset. It was not caused by regulatory setbacks. It was not caused by institutions losing faith in XRP's future. It was caused by market saturation at the institutional level. There are now so many serious players pursuing XRP ETF products that smaller operators are being priced out of the US market. That is not a sign of a dying market, that is a sign of a maturing market. When an industry gets crowded with serious competition, it means serious money has decided the opportunity is real. Serious money doesn't show up to dying industries. Serious money shows up to industries where the returns are compelling and the infrastructure is viable. The XRP ETF space is now attracting the kind of institutional attention that tells you the smart money has made its assessment. CoinShares leaving doesn't change that. If anything, it confirms it. The table is getting crowded, and the people taking seats are bigger than ever. I want to step back from the market mechanics for a moment, because I think there's something happening here that goes beyond ETF filings and OTC desks and order book depth. Something that I think about a lot when I look at where we are in this cycle. Most people who are deep in the XRP community, who track every filing, watch every hearing, read every court document, they got here through a specific moment where something clicked. Maybe it was a video that explained how XRP could serve as a bridge currency for cross-border payments. Maybe it was reading about how the global correspondent banking system wastes trillions of dollars in trapped liquidity every year. Maybe it was understanding that the current financial system, with its 2-day settlement times, its opaque fee structures, its exclusion of billions of unbanked people, was built for a world that no longer exists. And suddenly the idea of programmable, instant, near-zero cost value transfer didn't seem like science fiction anymore. It seemed like the most obvious thing in the world. That moment, that click, is what most of the world hasn't had yet. We're talking about 8 billion people on this planet. And the overwhelming majority of them have no idea what blockchain infrastructure actually is, why it matters, or how it's going to reshape the financial systems they interact with every day. Every ETF that launches is a bridge, not just a financial product, a bridge between the old financial world and the new one. When a retiree's financial advisor starts recommending XRP ETF exposure, that retiree doesn't need to understand wallets or private keys or consensus mechanisms. They just need to understand that this is part of a new financial infrastructure that serious institutions have decided is worth owning. And that's enough to start the conversation. That's enough to plant the seed. BlackRock running an XRP ETF doesn't just bring money into the market, it brings credibility, it brings legitimacy. It brings the kind of institutional endorsement that reaches people who would never watch a crypto YouTube channel but absolutely trust their BlackRock fund manager. That's the billion-person wave that's still coming, and the filings and withdrawals and OTC dynamics we're talking about today. They're all just early chapters of a much longer story. Okay, let's bring this back to practical ground. What does all of this mean for you as someone who holds XRP or is considering it, or is just trying to understand the market? First, don't make decisions based on rumors. We've established clearly that the BlackRock and Fidelity filings are unconfirmed. If those filings happen, they will appear on the SEC's EDGAR database as publicly available documents. Check the primary source before you act on anything. Second, understand that the CoinShares withdrawal is not a reason to panic. The reasons behind it are strategic and competitive, not a reflection of XRP's fundamental prospects. Third, pay attention to OTC inventory signals. When analysts start reporting that OTC XRP supply is running thin, that is a leading indicator of potential price movement, not a lagging one. By the time price moves dramatically, the OTC inventory will already be gone. The people who understand this dynamic and position accordingly will be ahead of the people who react to price movement after the fact. Fourth, zoom out. The XRP ETF market is in early innings. The products launching now are building the infrastructure and regulatory precedent for the larger wave that follows. If you're measuring success on a week-by-week basis, you're probably using the wrong time frame. The story playing out here is measured in months and years, not days. Fifth, stay informed but stay skeptical. The information environment around crypto is incredibly noisy. AI tools, social media accounts, and even well-intentioned analysts get things wrong constantly. Build the habit of asking, what's the primary source for this claim? If there isn't one, treat the claim as speculation until one appears. Alright, let's land this plane. Here's everything we covered today. CoinShares withdrew their spot XRP ETF filing from the SEC, and that is a confirmed fact, not speculation. The withdrawal was driven by competitive market dynamics and strategic resource allocation, not by any fundamental problem with XRP. BlackRock and Fidelity filing a spot XRP ETF remains an unconfirmed rumor, plausible but unverified by any official document as of this recording. Ripple faces meaningful legal constraints on direct institutional XRP sales in the United States, constraints that cannot be easily rooted around through creative corporate structures. As a result, ETF providers must source XRP through secondary market channels, exchanges, and OTC desks rather than directly from Ripple OTC desk. Inventory is finite and being drawn down by growing institutional demand. When that inventory is exhausted, institutional demand will hit public exchange order books with significant potential price implications. And all of this is happening during the early innings of what appears to be a major institutional adoption wave for XRP. That's the full picture. Facts, context, analysis, no hype, no panic. If this video gave you value, I'd genuinely appreciate a like. It helps more people find this content. Share it with someone in your circle who's trying to make sense of what's happening in the XRP market right now. Drop a comment below, tell me what you want me to dig into next, or tell me where you think I've got something wrong. I read every comment. I take every piece of feedback seriously, because this community is how we all get smarter together. Stay sharp, stay patient, trust documents over rumors, and I'll see you in the next one. Peace.